My name is Gareth Hexter. I'll be hosting things for today. Really pleasing to see a lot of familiar faces, a lot of clients, a lot of you that aren't clients, or not. And have a lot of people here actually that are really new to Westwood and what we do. Hopefully we'll educate you a bit more over the coming slides. I'll just put this down. A couple of housekeeping points as usual. Told there's no fire drills today. If you do hear something, please act appropriately. Mobiles, if you don't mind, switch to silence. I think the Wi-Fi is around conflicts and their password required. Feel free to tweet, LinkedIn, whatever it is you do on social media, let people know you're here today. On the tables, got a bit of information about some of the solutions that we offer, and there is of course the obligatory feedback form. If you could give us a couple of minutes to fill that out, that would be brilliant. It does actually shape what we present and give to you after the session as well. Excuse me. As you can see, not now, we're doing all by mobile phone, not by DSLR. We are recording the session. So it will be available to you afterwards, along with some of the event materials as well. Presenters for today, again, will be very familiar to you, especially if you were here in October or one of our previous sessions. So I won't go through and introduce everybody, but to say we do have a guest speaker with us today, Scott Levine from Bloomberg Intelligence. Thank you, Scott, for joining us. A little bit about Scott actually, because I'll be familiar with the rest about him. Scott is the senior analyst covering energy and industrial services for Bloomberg Intelligence. Scott joined BI in 2016, having spent 15 years on the sell side covering energy, industrial and technology stocks, Imperial Capital, high-performing UBS. He has BS in finance from the university and an MBA from New York University. Join us. So my colleagues around the room, seeing you came in, thanks to the team for support today. If you need any help, just grab one of us. Quick recap, what we were talking about. We have Mark coming up on EPC, three-year integral split, rig market, and then Scott will be giving us a company review. And much to their relief, the panel session, we asked them to come and set the stage at that point, not before. I was actually looking at my preamble from October. It was a typical question would be whether it's changed 6 months away from back. Well, we're back because you asked us to do these every 6 months based on the feedback. But also just a bit of narrative, I suppose, on where we are over the last 6 or 7 months. When we were last here, Mark spoke about optimism and challenges to the EPC market, and that's something that's continued. With a bit of a catch-22 situation, built from oil prices, which is around the $80 mark, combined with inflation pressures, and of course the shortage of equipment. Terry and Teresa spoke about rising utilisation, day rates, and awards activity, and we've seen it happen more surprising elements since October, and that was perhaps more a pattern of day rates from the floaters, where at the time we spoke, that was the direction of travel. So perhaps the strong upward stride on there perhaps tapered off a bit more. Broadly speaking, the recovery has continued, and if you look regionally, we see a continued surge in the Middle East. The question obviously still remains, where's the supply going to come from? And of course, looking to the North Sea, and Teresa wrote an article just a few weeks on this, the UK windfall tax has potential, and already seen driving rigs and operators out of that market. And on company sentiment, which Scott's going to speak to, there's a feeling of cautious confidence. 2023 off to a good start, and that's despite there being a lot of sensitivity on the company side to significant macro changes. So that's a bit of narrative as to sort of 6, 7 months, and the team will go through that in more detail. These slides will be in the deck when we come through, so I won't speak to each of them. But suffice to say, if you don't know who we are, we're Energy Market Intelligence Consulting. been around for a long time now, one form or another, going back past 25 years in various legacy brands. And we're essentially covering E&P, new energies, offshore energy services and onshore energy services. So you see we offer a range of solutions into each of those segments. We're going to be speaking about offshore, fairly obviously, it's the title, but we'll be looking at three of these areas today. One we won't be touching on perhaps is the marine vessel, but we will find some information on the tables around our global offshore navigator product, which we've worked with on Graham to produce. If you want any more information on that, do give me a shout afterwards, or indeed Mike, you here? Mike Graham will be able to fill in on that as well. More recently, we've developed our new energy sector. If you're familiar with that, you're probably more familiar with wind logics, our offshore product, but we're also covering emissions, CCS and hydrogen through the branding of our Atlas Energies. Again, if you want information, do please speak to us afterwards. And then within the pack, you'll get the information on each of the actual solutions, such as very bright wind logics, subsea, platforms as well. That's it from me. I'm going to hand over to Mark to kick things off, and then we'll work through the panels and we'll have Q&A at the end. Mark, if I can invite you. Thank you.
Cool. Thanks, Darren. Let's start here. So basically, starting from what Garrett said earlier in terms of where were we the last time we spoke and where we are now. I think 2022 started with a lot of optimism, as you can see from the chart right there, with about 80 billion of offshore EPC contract award value expected in 2022, and that will include the production facility, both fixed and floating production systems, as well as all the subsea components. However, as the year went on, that optimism somewhat dwindled away. And from the chart, from the map on the left-hand side of the screen, you can see quite a number of projects that we're tracking that were initially planned to reach final investment decision in 2022. But due to various reasons, most of which was project inflationary pressures, a lot of operators decided to either hold off, change development concepts, or cancel some of those projects in its entirety. And due to that reason, that optimism that brought about over 80 billion of offshore EPC spend actually closed at about 53 billion. Even though that represented a 29% increase year on year, that's still a 35% decline at the close of the year compared to January 2022. So that's quite significant. And even if you turn down its head, you look at the subsea market, that represented a 14% downward revision in the number of subsea trees that we were tracking to be awarded in 2022. So that said, that challenge has not gone away. The challenge of cost inflation is still within the industry. And if you look at 2023, we are looking at about 78 billion offshore EPC spend. That's quite optimistic as well. A lot of those, we believe, will be coming from Latin America as well as the Middle East. Although traditional West African basin is expected to also be a bright spot. And I'll be touching on that a little bit later on. But the challenges have not gone away. So that's 73 billion, as you can see from the bottom chart there. In terms of how we started the year, in Q1, we've barely recorded 8 billion of offshore EPC spend. So that's relatively a slow start when you compare that to 2022, same time last year. But we'll continue to track the market as the market changes overall. But overall, when you look at the 2024, 25, 2026 period, we are looking at EPC spend closer to 60 billion, more or less stabilizing at about 60 billion. And that is because we currently, and we still believe in our oil price estimate, which is oil prices to trade between $70 and $90 this year. and then stabilize above $65 over the near term. And we've seen that Saudi Arabia is ready to always intervene in the marketplace, just to be able to meet their own fiscal break-even costs. So this chart is having a quick look at how we are currently measuring cost increases. So what you can see here is subsea EPC spend by FID. So a significant increase when you compare 2020 to 2021. Then over the 2021-2022 period, we saw a 10% increase in terms of the subsea EPC spend by FID. But over the next 2 years, we anticipate that could easily go up by another 10 to 15%. And that is because uncertainties remain. The war in Ukraine is still a concern, supply shortage, as well as labor shortage as well. And that is where the catch-22 is in terms of we do want oil prices to be flat, to remain high. We want operators to continue to sanction projects. We want those subsea trees to be oiled. We want those production facilities to be fabricated. However, prices are beginning to go up, and operators are really not pleased about that. So if you look into 2023, right now we are tracking 70 FIDs. Like I said earlier, a very slow start if you look at the number of FID counts so far this year in Q1. But we've actually highlighted a few projects that have actually passed FID this year. I would say the big one that's actually passed is the Angola project, offshore Angola. But we're still tracking a few, especially we anticipate any moment from now in terms of the number of days or weeks. ExxonMobil will sanction its Westwood project offshore Guyana. Obviously, a lot of letter of intent as well as limited notice to proceed has been issued to contractors. So that will form a significant proportion of spend that we track for the second quarter. But then you also look at projects like ENI's Levine, which ENI has somewhat been very, very creative about, more or less splitting the project into 3 phases. Phase 1 sanctioned last year, phase 2 is expected to be sanctioned. Phase 2 was actually sanctioned in Q4 2022 as well, where a few contracts are still pending for that to move forward. So that's where we see some of the hotspots going forward. In Brazil, investments in the remaining phases of Buzios is what we also see in the near term to drive the number of FIDs. But then you start to look at Southeast Asia, you start to look at the Middle East, investment in brownfield projects, especially in the Middle East. You can talk about the Safinaya field, the Marjan field, the Zulu field, and that would require a lot of fixed platforms, a lot of rigid line pipes, as well as subsea cables. And that is what is driving the length of rigid lines that we currently anticipate in 2023, looking at those pie charts. So a quick one running through the subsea tree demand in the near term. So we are looking from Q1 2023 up until the end of 2024. Traditionally, the golden triangle remains golden at this point in time based on the size of projects that we're tracking. Definitely spoke about Guyana earlier, but there's been a lot of optimism previously on Suriname, Block 58, but we see Total Energies is yet to make that final decision on how they want to progress based on some of the ongoing drilling that is going on there. Terry is going to more or less shed more light on that particular topic. But we also look at Woodside and a history on projects offshore Mexico. We also look at Pollock and Chihuahua offshore Mexico as well. And the previously delayed non-plat project in the Gulf of Mexico when Total Energies pulled out of that particular block is expected to move forward. Right now, we believe that Shell is looking at replicating what is done on the Vito field as well as the Whale field on that particular development. And we anticipate a final investment decision in 2024 at the latest. If you look at the East Med, we expect the Sakaya field to be expanded in the near future, but there have been a lot of new discoveries right there where ENI is looking to fast track its Block 6 development, either using a floating LNG facility or tying that project back to Egypt. So there are a lot of potentials in the East Med as well. There's Block 10 for Exxon, which also has a few discoveries. But overall, if you look at the number of subsea tree year on year, what we actually see is more or less a positive outlook, even though it's more or less a very, very slow growth. But at this point in time within the industry, any growth is welcome. So here is a quick look on our subsea tree installation outlook. A lot of the subsea trees have already been awarded, but a couple of points I would like to point out here is the move to ultra deep activities. So if you look at the 2022-2026 period in comparison to the 5 years past, there is more or less a 5% shift into ultra deep subsea tree installation. So all those high spec rigs will definitely be put to use in the near term as well. Although you can see in shallow water, less than 250 meters, and that also grows by another 7% or thereabout. And that is because last year, a lot of operators, well, predominantly Aker BP and Equinor, took advantage of the Norwegian tax incentives and definitely sanctioned quite a number of projects. This project will be still moving, but that is what is driving some of the shallow water subsea tree installation thereabouts. Also, if you look at the bar charts, I think it's fair to say how the Americas actually expands post 2024. So you can see a significant growth in that region, while we are also seeing Africa coming back to its own place post 2023 as well. So if you look at the African market, since 2020, it's been very, very more or less half of itself previously, but now we expect to see that growth in the installation market as well. So yeah, a quick flip through the production facilities, which is quite important. It's another place where we're seeing significant demand. Operators are beginning to get much more creative around how they develop these fields. Significant demand coming from Brazil. There's a lot of tenders out there. Last year they did award the P82 and P83 FPSOs, which were quite very expensive, very close to 3 billion each. And that definitely skewed the market in terms of expenditure as well as capacity. So I'll be talking about capacity addition over the next couple of slides. But then what we're seeing, especially in 2023, is operators are deciding to look at redeploying existing facilities, either their upgrades or conversions of tankers. But there's a lot of upgrades going on. We've seen that with the Berlin project. The first unit was upgraded. The second unit is expected to be upgraded as well. And while we also look at the Rosebank development offshore the UK, where Altera is expected to redeploy another upgraded unit. So in order to manage cost, operators are beginning to look at creative ways in reducing the upfront development cost of a lot of the offshore developments, and why there's that shift to upgrades and conversions as against new builds. However, talking about new builds, we expect that is still going to be the case in Latin America. It's well documented in terms of number of units expected to be deployed offshore Guyana over the next few years. I think ESA has been talking about 10 FPSOs at least, only 4 of which have been contracted to date. But we also see Petrobras more or less releasing additional tenders. We definitely released a tender for the Sagapia Lagoas Unit 1 and Unit 2, the P84, P85 units, which are termed as all electric, is expected to be tendered for this year as well. But those 4 units I just mentioned, we do not anticipate that they would get sanctioned until next year. So looking at the other chart on the left-hand side of the screen is the fixed platform market overall. I already mentioned some of the brownfield developments and the CRPOs being released by Saudi Aramco, and that is what is actually driving our market. But then you look at Southeast Asia as well, as more or less a rebound, and we're seeing a lot of gas fields getting developed down in Southeast Asia. So this is just a quick look on the capacity addition. I did mention in 2022 we saw a significant number of capacity of FPSO added based on units that were sanctioned. But I think the takeaway here is when you look at the splits on a 5-year time period, you can see 2022 to 2026 is almost doubling what we saw over the 2012-2016 period. And that is telling us that there is more capacity needed within the industry. There's more drilling to take place to be able to utilize all of those FPSOs capacity. And those pie charts at the bottom of that bar chart also tells a story that been mentioned earlier as well, which is the shift to Latin America. So significantly, you can see over that 5-year time period, the Latin American market continues to expand, accounting for about 66% of new capacity over the 2022-2026 period. A couple of slides left. I'd like to finish the presentation on a positive note, and this is talking about discoveries. So these are high impact discoveries over the 2021-2022 period. Obviously, this is non-exhaustive, but what we're just trying to point out here is, should any of the operators here listed based on these discoveries decide to fast tracking of this development, this will represent a significant upside to all of the forecasts that we've been talking about. Obviously, upside when it comes to production facilities, upside when it comes to subsea flow lines, subsea pipelines, and upside when it comes to subsea trees as well. Definitely mentioned some of the opportunities in the East Med, and there's still a few high impact discoveries that currently do not have development timeline or a development concept, which means that there's a lot of early engineering opportunities based on some of these new discoveries as well. Lastly, I would like to talk about carbon capture storage. Gareth did hint on some of our product that covers that, but we're looking at this from the subsea opportunities. So if you look at the carbon capture market right now, and what we're talking about here is offshore storage. And the market is expected to exponentially grow in 2024 and 2025. So in 2024, we anticipate the market for subsea equipment required for carbon capture storage will be talking at least $1.3 billion US. And in 2025, we anticipate that should grow almost to 1.6 billion. And you can see quite a number of projects that we're tracking right there as this project progresses. The first phase of the Northern Light project, that was the one that was sanctioned in 2019-2020, and we see that to have the second phase as well coming up shortly. So we've highlighted a lot of those projects without going into specifics, but we see a lot of opportunities within the carbon capture storage as well. So just to round up, the key takeaway here is inflationary pressures is causing FID delays. So even though we currently forecast 78 billion in offshore EPC spend, the possibility that we will end the year lower than that point is highly likely. So over the forecast period, year on year, 2023 to 2026, we anticipate that subsea tree demand year on year is going to top 320, and that is driven predominantly by activities in the Americas. Didn't mention other projects. So for example, we're looking at the Baby North project offshore Canada to move to FID possibly late next year or early 2025, more likely next year, as a FEED contract have just been awarded. And even if you look at the overall offshore EPC contract award value over the forecast period, we're looking at about 68 billion in that sphere, and that is predicated based on oil prices staying above $65 per barrel over the 2024-2026 period. So outside the buoyant forecast, we definitely see an upside to that forecast, and that is based on new discoveries. We didn't really mention so much around Namibia. There are also opportunities with Total Energies developing the Barracuda and the Levine field offshore South Africa as well. Those are projects that we believe will go ahead over the forecast period. And then you look at the continuous investment offshore Guyana definitely represents significant upside in the latter years of the forecast period and beyond. So that said, I will take any questions in between, but I will also invite Teresa.
Thanks, Mark. Just before we get Teresa up, and before we dive headlong into rigs, there will be a Q&A at the end, but if there's anybody that has a question for Mark now, we'll pass to the end. Okay, thank you very much, Mark.
Thank you.
All right, okay, that's fine. So what I'd like to do before the next two presenters come up, so Terry's going to give a bit of flavour on the Americas markets, Americas rig markets, and then we have Scott who's going to come up and do a little bit of a company review. I want to kind of just give a bit of flavour on the global market, so what's been happening in terms of supply, demand, utilization, day rates for the jackup semi and drillship markets. So first of all, taking a look at where we are now in terms of supply versus 2 years ago. So due to reactivations and new build deliveries, we have actually witnessed an increase in marketed jackups by 31 units and an increase in drill ships by 20 units, and that's very much driven by that tightening of supply and demand balance, and also the heightening global utilization in those segments. Meanwhile, in the semi-sub segment, we have witnessed something quite different. So you can see on the right-hand chart that demand has actually only increased by two rigs between January 2021 and now. And we've actually seen market supply decrease by 2 rigs, which has of course helped buoy utilization, despite that lackluster demand in the segment during that period. From these two small pie charts as well that you can see here, 18 semis were retired in that same period, while 24 jackups and 7 drill ships were also removed from the fleet during that time. On the other hand, the majority of new build deliveries were for jackups, and just 20% of those new builds were drill ships, and we haven't seen any semis delivered during that time. In terms of global committed utilization, drill ships are very close today to being sold out at 97%, and jackups are now at 91%, while semis are a bit behind at 85%. Regionally then, the Golden Triangle drill ship market, consisting of the US Gulf, Brazil and West Africa, is now at 100% utilization, and semi-subs are at 98%. The Med and Black Sea floater market is also at 100% utilization. For jackups in the Middle East, the Persian Gulf and Red Sea areas are currently at 96%, Southeast Asia at 95%, and India at full utilization. Meanwhile, the North Sea region is lagging behind a little for both harsh environment semis and jackups. Jackup utilization is currently sitting at 86%, while semi-subs are at 83%. And that's even after several rigs have departed the region over the past few years. So changes to the UK fiscal regime, which Gareth mentioned a little bit earlier, as well as sluggish Norwegian demand over the past year or two, have all contributed to this lower demand and lower utilization. However, as I'll discuss a little bit later, we do expect to see some upward movement in this area in the next year. Alright, so just a little bit of a regional analysis on where that demand and award activity has been. So the left-hand chart is showing awarded contract days for jackups from 2015 to the end of March this year, broken down regionally, and also shows the average contract duration at the top of each column as well. So you can see that 2019, 21 and 22 were all growth periods for jackup awards. All were well above the previous years of 2015 through 2018. And of course, 2022 was an extremely high demand year for the Middle East, as we saw NOCs such as Saudi Aramco ramping up their reserves and production. We also witnessed an increase in awards in North America, majorly from Mexico as well as India. 2022 was also a bumper year in terms of average contract duration at 38% higher than 2021. So far this year, this segment is falling behind a little bit in awarded days, which are approximately 3% lower than the same period last year, and the average duration is sitting at just over 400 days, so around 35% less than last year's total average. So yeah, a slightly slower start to the year. And then in terms of floating contract awards, except from the dip during the COVID pandemic in 2020, there has been growth year on year in terms of floating rate award activity. So last year was the most floater contract days awarded since 2012, and average contract duration was also the highest since 2012 as well at 272 days. Unsurprisingly, South America has been the biggest growth area between 2015 and 2022 and had the most awarded days for floaters last year. And that is, of course, really driven by Petrobras in Brazil, but also additional days awarded for work offshore Guyana, Suriname, and Colombia. Meanwhile, despite some of my previous comments, the North Sea also recorded an increase in awarded days last year, with 68% of that coming from Norway and the remaining 32% from the UK. However, of those contracts, a significant proportion is for work that starts in 2024 or onwards. For the first quarter of this year, award activity is holding up pretty well for the floater market. Awarded days for the first quarter are 38% higher than the same period in 2022, and average contract duration is currently at 394 days, which is 45% higher than last year's full year figure. But of course, we still have quite a bit to go through the year, so that may well change. All right, so what I wanted to do here was just a bit of visualization of some of the regional supply changes that have come about due to the growing demand in certain areas. So firstly, the Middle East. Well, this is specifically the Persian Gulf that I'm showing here. Between January 21 and the end of this year, will increase the supply by 24%. And as you can see here, that capacity has been brought in from other regions, such as the North Sea, West Africa, India, new builds, and active supply from the Far East, and mass of units from Southeast Asia. This, of course, has resulted in lower supply in these other areas, especially in Southeast Asia, where we are often now hearing of limited responses to tender processes due to the lack of availability. The Middle East has become a very attractive area due to the multi-year campaigns that are on offer at increasingly attractive commercial terms. And secondly then, looking at Brazil, we've also seen rigs moving into that region due to Petrobras ramping up of drilling operations over the past year or so. So a number of cold stack units from Las Palmas, which we consider to be West Africa regionally, have been reactivated and have or are being brought over. Additionally, we've seen units moving in from other parts of the Americas and Southeast Asia as well to help meet that demand. And then lastly, on the opposite end of the scale, we have the North Sea, which has quite rapidly decreased in supply in line with that lower demand that I've been speaking about. So we have seen both harsh environment semis and jackups from the UK and the Norwegian sector lead the region for areas such as West Africa, Australia and Canada to find work elsewhere. And we also expect to see a further 1 to 2 units confirmed for exit later this year. So with this increasing utilization and decreasing availability, we have seen further day rate increases across most of the rig segments. A bit of a disclaimer around the day rates first. Within rig logics, we do try to get as close to the bare or the clean day rate as we can. So that's a rate that doesn't include additional services such as your mobilization fees and other services. That can sometimes be included and that can often inflate the base rate. However, that's not always very easy to do depending on what information can be found. But generally we try to get as close as we can, though sometimes we can only record a rate that does include those services. So what I've done to try and help is to have these average day rates guidance behind the fixture dots themselves as well. So firstly, looking at the benign jackup segment, since the first quarter of 2021, we've seen average rates increase approximately 23% to an average of around $97,000 per day in the first quarter of 2023. And that's despite a slight dip during the first quarter of this year by around 2% compared with the last quarter of 2022. So this past quarter, we saw rates range from $66,000 per day for a rig off India to $157,000 per day for a unit to work offshore New Zealand. In the semi segment, from the first quarter of 21 to the fourth quarter of 22, we did see some upward movement in the benign semi market. However, the harsh environment market was really quite flat. However, last quarter, we actually saw some North Sea sixth generation semi-sub fixtures, about $400,000 per day for the first time since 2013. However, those contracts don't start until the last month of this year, so December 23 and into 2024, but an indication perhaps of where the region is moving in terms of day rates. For drill ships then, again, we have seen some further increases in average rates during the past quarter, but I would say in terms of that, we haven't seen the increases that we had initially expected to, at the same pace we had expected to. And I think that's from ourselves, but also from speaking to others within the market too. So we saw a couple of rates hit the highs in sort of 450 to 460,000 a day, and that was last year. But really, since we've seen rates level out in the 370 to 420 range for the past quarter. We're still hearing chatter about the first drill ship contract to come out at $500,000 a day, and it sounds like we are probably quite close to that. But we do expect that this rate, if it does get fixed, will come with some additional services. So it's unlikely to be a clean rate of $500,000 a day. However, as you can see from the chart here on the right, average rates for the past quarter increased further to $410,000 per day, which is 109% higher than the same point in 2021. So still performing really strongly. So taking a look at some of the outstanding inquiries in the market then. The map here shows how many jackup and floater inquiries are out. So in the orange, representing floaters, you can see the majority of demand is coming from those already very busy areas of South America, where Petrobras has various multi-year tenders outstanding. Also, the Mediterranean and Black Sea have some interesting campaigns, while the North Sea semi-market still has various greenfield and P&A campaigns outstanding, and similarly for the UK jackup segment as well. So some of these are a bit unclear as to whether they will move ahead due to those changes to the windfall tax, but those inquiries are still out in the market. And also we're seeing some pretty decent demand coming out of Southeast Asia and Australia as well for the semi-subs. In terms of West Africa, it's also an area that has been gearing up in terms of demand as well, which has really been buoyed by recent giant discoveries offshore Namibia, South Africa, and Ivory Coast, which Mark has already mentioned. as well as the likes of Total Energies, which we hear are talking about adding a floater or two to its fleets offshore Angola and potentially more offshore Namibia as well. So we believe this will be a growth area in the coming years too, especially for the deepwater segment. On the jackup side, I've already mentioned some of those challenges with the North Sea, but yeah, still various outstanding requirements there. Also some in the Dutch sector and the Norwegian sector as well. And then in the Middle East and India, we aren't actually showing that many requirements on here, and that is basically because we are waiting to hear of several inquiries coming out from those markets. So we understand that Saudi Aramco are rumoured to be preparing to come out for an additional 6 to 10 jackups, and likely there will be additional needs from Qatar and UAE as well as OMGC, which is believed to be about to issue a tender for up to 10 rigs as well. So some of this will be to replace existing contracts, but we do expect that it will result in a need for more supply in those areas as well. So growing demand outlook, but as I've already said, the market is close to sold out in many segments, so where is this capacity going to come from? So there are various rigs, of course, due to roll off higher this year, but equally there are a lot of options attached to most of those contracts too. We already have 17 jackups, 1 semi and 5 drill ships being reactivated from cold stack ahead of new deals. And we're aware that many of the stranded or rebuilt drill ships and jackup assets are already being considered by potential buyers or for bareboat charters. And we expect that there will be more news about these over the coming months. Drilling contractors have stuck to their word in terms of securing work for new builds or reactivation candidates before bringing more tonnage into the fleet. And we expect this will continue considering the time and the price tag that is associated with doing so. So basically, to meet growing demand, we expect that further reactivations and new builds are going to be needed, but we do expect that operators will be the ones who will be paying for the majority of that. And then just a quick overview on what we expect to see in terms of the next couple of years. So across the 3 segments, we're confident that the recovery will continue over the forecast period. For jackups, we expect demand to increase, and off the back of that, more tonnage will be brought in. Utilization will continue its upward path and make its way towards 95% over the next year. Semi-subs, although have made that sort of slower progress due to that sluggish North Sea demand, we expect that if the North Sea segment doesn't soak up that capacity soon, that other regions will. The very tight drill ship segment could mean operators may look to take a semi where they can instead of a drill ship, where there's more availability and slightly lower rates. However, Norway does actually look to be brighter next year, so we may well see Norwegian operators becoming a bit more urgent in sort of fixing up units for those campaigns soon. And then for drill ships, of course, I've said it already, we're already seeing that market being close to sold out, and we believe even though extra capacity will be brought in, it will be on a sort of as and when it's needed basis. So we expect drillers will avoid sort of flooding the market and driving down utilization or day rates. And then just a couple of the key takeaways. So we're seeing the main market fundamentals continuing to improve, and again, that's backed by those supportive commodity prices and most countries focus on energy security. NOCs are still the biggest drivers behind demand. We expect that to continue, but large discoveries in areas such as Guyana and Namibia by super majors could also drive more demand in these newer areas as well. Day rates continue to trend upwards, albeit at a slightly slower pace than we had first anticipated in some segments. But we've seen some recent upward movement in the North Sea semis, which has really been a long time coming. The demand outlook remains strong, but capacity may start to be more of an issue over the next year. Therefore, market supply needs to increase, whether through reactivation or new builds being brought out of yards. And that is my sort of key point. So I'm going to hand it over to Terry, and he's going to talk us through the Americas.
All right, thanks, Teresa. Thanks everybody for being here today. I'm going to talk a little bit about the Americas. I won't be too long, hopefully, if I can keep myself from going off topic too much. But the Americas, by and large, I believe you're really talking about mostly a drill ship or floating rig market in the Americas. The jackup market in North and South America is primarily driven, concentrated in Mexico, and I will talk about that a little bit. But basically right now what we see, as Teresa pointed out a little bit, 100% market utilization. There's 47 drill ships, semis, 15 of those, utilization at 93%. That is just one idle unit, and of course jackup market utilization 95% and just 2 idle units. So, and I think both of those being in Mexico. As I talked about in the U.S. Gulf market and jackup fleet, there's only 6 marketed jackups in the U.S. Gulf. I think 5 working right now, and 1 to come on in May. So in Mexico, a different story. We've got 34, I want to say, contracted jackups there. Pemex has just extended all of those contracts, or most of them at this point, by I think for 2 years on most of those contracts. Now there are some outside operators. We just saw the contract from Borg Drilling just the other day for I think Fieldwood is the operator off of Mexico. So clearly some other work, but obviously driven mostly by Pemex. Some things, there are a few bumps on the horizon. Teresa talked about 100% utilization, drill ship market sold out. But there is some idle time, I think, in the U.S. Gulf that could creep into the fleet later this year. Some of those units, the contract terms are starting to run out in the next couple of months. Some of those being marketed outside of the Gulf, which to me is somewhat telling, in that if you're having to market these rigs outside of the Gulf, maybe there's not quite the demand here that there may be later on, or that we thought might be here. But still, nevertheless, I'll talk about that in a little more detail later. As I mentioned, Pemex extending the jackup contracts. There's still some of those that end later this year, late this year, so look for those obviously to be extended as well. The major issue in Mexico at the moment has to do with drill ships. The Mexican Navy's desire, or now new requirement, to class drill ships as vessels. I think, which would require a drilling contractor to form a joint venture with a Mexican company and so forth. That's certainly causing an issue there. We've seen the Noble Drilling contract with Petronas, I believe, that's been delayed since January, and that rig's still waiting because they can't get into Mexico yet. So a potential issue with that. Otherwise, South America, as Teresa mentioned, that's certainly one of the most watched regions globally, particularly for the floating rig fleet. Combined 37 floating rigs now in that region, 4 more set to mobilize there this year. All of those coming from rig reactivations, and certainly likely more contracts signed for additional units that will come from outside that region later. So this is a pretty telling slide, I think, looking at contract days for floating rigs signed in the Americas versus the rest of the world. And what you see there is the dynamic is there's certainly been far fewer contract fixtures in North and South America than the rest of the world. However, as you see on the total number of days, it's certainly higher. When I came up with 199 fixtures in North and South America since 2018, compared to 302 in the rest of the world, but total days over 67,000 for the Americas compared to 64,000 for the rest of the world. So clearly fewer contracts, but a lot more long-term type deals signed there. As you see on the chart on the right-hand side in particular, gives you an indication of how busy that market is. This market's going to remain. In the tender days outstanding, over 13,000, almost twice as many as compared to the rest of the world. So clearly long-term charters, obviously in Brazil, Guyana, of course, and the U.S. Gulf account for the bulk of the contract award days. Obviously Suriname, Colombia is starting to become more active, accounting for some of that as well. So we talked about the fixtures and the 13,000 days remaining are in the outstanding tender days. So clearly still a very good outlook in the Americas, but with a couple of bumps potentially that we see coming, and I'll speak to that shortly. So looking at day rate fixtures, and this again is mainly for floating rigs. I'll speak to jackups, and jackups in the Gulf of Mexico are pretty much in a comfortable day rate range right now. I'd say in the 85 to 90,000 range. I think maybe some are being marketed a little bit higher than that, but generally in a very tight range for the 5 or 6 rigs that are contracted here. In Mexico, I talked about the 2-year contract extensions from Pemex. I'm told most of those rates being in the sort of 115 to 130,000 a day range. The bore drilling jackup, however, generally the outside operators get a little bit higher rates. The bore drilling contract for Fieldwood that, as Teresa talked about, we calculated the clean rate. I think we had it around 153,000. Although the reported contract value had it closer to 170, all in counting motor costs. So clearly, certainly a good sign of being, if it is 153 or around there, then that's certainly a positive sign for that market. South America, the outside of Brazil, I think there's only 2 jackups at the moment, both of those in the 120 to 125 range. Including the large jackup coming from New Zealand to Trinidad to replace the Noble jackup that was damaged. So in looking at the chart here that we have, you can see the floaters. Again, America's in the orange versus the rest of the world. You can see all the higher fixtures, particularly in the drill ship side, which is where most have been in the recent months. All coming from the Americas. However, as I also alluded to, we've also had some fixtures, or as Teresa mentioned as well, we saw a trajectory of day rates where everything was above 400,000, and that's where a lot of the market, and probably including us, thought maybe that path would continue on that trajectory. But we haven't seen that, as she mentioned. We've seen really more of a plateau on the high end. And we've also seen some fixtures dip below 400,000 a day. We've seen some 380s and even rumors of a 5-year contract for a drill ship that's just been signed that we hear could be as low as 350,000. So clearly, for rig owners, not exactly where we thought the trajectory might be. Now, Teresa also mentioned the potential 500,000 a day rumor that we hear. We think that's pretty close to being signed. Although, as she mentioned, I'm not sure that that's going to be a clean rate. I would assume there's some mow or something in that, but we'll see. If it is a clean rate, it certainly would be a really good sign for drilling contractors. But still, even if it's not clean, it's probably still going to be a pretty substantial rate. But by and large, we just haven't yet seen that continued path upward. And with the supply, the little supply bumps coming up, I'm not sure that we will anytime soon, but I think we'll still see decent rates for rig owners and ones that probably operators can live with as well. So talking about Brazil, a little bit in particular. As Teresa showed in one of her slides, drill ship supply there has increased by 5 rigs since 2021. I mentioned the 4 others set to join the fleet later this year, and probably ultimately will be more than that. So at least 8, I don't know what I wrote there, I'm not sure what that's supposed to mean. 8 floating rig outstanding tenders remain. Most likely to be awarded to incumbent rigs, but I think also there's certainly that's going to require some additional incremental supply to come into that market. So overall, there you've got 40 rig requirements from 13 operators. So clearly, plenty of work there at present, and I think most of that will continue to be development, workover type drilling. I think the A&P has projected 11 exploration wells this year to be drilled offshore Brazil. So certainly some of that activity, but the bulk obviously will come in the form of development drilling. Bids recently turned into Petrobras. There's actually been one jackup tender there. You see a long-term P&A program, and it's prone to happen in Brazil. The day rates bid for that work, I think, were $99,000 on the low end, $205,000 on the high end, and that generally happens when you see Brazil tenders because so many people submit bids, and you get companies that really want the work, and they tend to drive that bidding down substantially, and that's no different with the jackup tender. In fact, the jackup tender, the low bid was for a rig, an idle jackup in Mexico, which is another sort of first because generally Mexican-owned jackups have never ventured outside Mexico to speak of. So the fact that they're now being tendered in some of this work speaks a little bit to what's happening there, but still, I think that jackup work would be the first rig activity for that rig type in Brazil since 2016. So certainly something to keep an eye on. The hiccups in Brazil, obviously there have been some license relinquishments recently. ExxonMobil, both Petrobras relinquished acreage there after some dry holes, but still I don't think that's really caused too much of an issue overall in the country. So you can see the Petrobras CEO saying we may be the last to produce oil in the world, and so clearly in regards to energy transition and that shift, that's clearly everybody knows it's coming, but I think everybody also thinks it may happen, or a lot of people think it may happen quicker than it actually will. So it's coming, but it looks by how the Petrobras CEO is speaking that he likes oil for still a while to come yet. So, and I think that will be the case in Brazil. So, without any doubt. Mark talked about the high impact exploration drilling. The Americas is clearly, when you look at a map globally, is going to be the most busy region in terms of this drilling going forward. You can see all the wells that are planned there. And as it says, North and South America forecast to be the busiest regions globally in 2023. So, U.S. Gulf, those wells returning after a quiet and somewhat disappointing in 2022. Mexico, of course, that continues, although the drill ship issue, I'm not sure how that will impact things. Operators may turn to semis in some cases if they can't get a drill ship in, but we'll see. Of course, South America will, exploration-wise, will continue to be dominated probably more by Guyana than Brazil, but obviously Guyana, Suriname, and Brazil, and to a lesser extent Colombia. You've also got some activity coming up off Argentina with the Total with a big program there. So clearly the drilling is expanding in other countries, but still there's the core group of the 3, Guyana, Suriname, and Brazil, that will continue to account for most of the activity, rig demand in South America going forward. Now, this is probably, you can tell I made these slides because there's really nothing to them, but this is a very simple slide, yet I think it's pretty telling. So this is sort of a floating rig availability analysis. So what I did was I looked at current utilization and I took, okay, what rigs are coming available the rest of this year? Then I looked at those rigs and said, okay, of these rigs, how many do we think, and this was done internally, do we think either will have options exercised that will keep them working or have be awarded other work, be it in that region or outside that region, that would take them out. So, and it doesn't include any rigs that are already idle. Of course, in these regions, as we've already discussed, there aren't that many idle rigs anyway, but you see really the availability is mostly in the U.S. Gulf and mostly in the drill ship fleet. And you see 5 there. Now, I will say of those 5 rigs, I would expect that based on what I know that probably at least 3 of those probably have additional work coming up that would take them off this list. But at the time I did it, I wasn't quite sure enough if this work was firm enough to be able to remove them. So it's not, it looks like, oh, there's 5 rigs coming off contract, and there may well be, but I don't think there'll be any substantial downtime. If there is, it might be for 1 or 2, but I think most of these will have work, and I think some of those on that list, the work may be outside of the U.S. Gulf of Mexico, and probably will be eventually. Of course, when you start looking into South America in drill ship utilization, you've got 1 drill ship coming idle. I hear rumors that rig may be leaving that market as well, so that may go off the list. And of course, that leaves the semis in South America. So you've got actually 3 there. I think I said 2 earlier, but and that's kind of the same situation. I think 1 or 2 of those may have some follow-on work. So I don't really think this list is really indicative of the true number that may be available, but yet certainly not the work, not in a firm enough state yet to take them off the list. So some potential idle gaps coming up, but I don't think, based on what I'm told or what I know at this point, I don't know that it's going to be substantial. And lastly, I'm going to leave you with the Americas market outlook. So basically, obviously high utilization going forward. Drill ships 100%. Now, obviously, if we do see some downtime, maybe drill ships go to 99, 98% for some months during the year. But I think obviously it's still going to remain strong. Jackups, as we talked about, should remain at 100%. Even jackups in the U.S. Gulf. There was one the operator exercised a 1-year option to keep it until December 2024, which in the Gulf is quite a long-term deal for a jackup in the U.S. Gulf. So certainly I think that market looks good. And semis, I think, as I sort of talked about, could benefit somewhat if the drill ship market remains tight. Maybe some operators move to a semi if they need to do the drilling. I know I spoke to one operator who said in regard to the drill ship issue in Mexico that, well, maybe we do just look at bringing semis in. So clearly I think that market will benefit from the downturn, any downturn or lack of availability in the drill ship market. So overall, still a very healthy market, I think, going forward the rest of this year and into next year for North and South America. I think if you look at the floater contracted rigs right now, half of them have deals that don't end until 2025 or later. So it's still a pretty good market right now. And that's all I got to say. And so, Scott,
Okay. So I'm going to wrap wrap things up, I guess, from the presentation side, and give a little bit of a different perspective. I am the Senior Energy and Industrial Services Analyst for Bloomberg Intelligence, and Bloomberg Intelligence is the research arm of Bloomberg LP, the financial technology and media company. We are a lot like the sell side, different lots of little ways. We've been around since '09, and we don't buy, sell, hold recommendations, but we offer opinion on various sectors, and we employ roughly 350 analysts, equity, credit, policy, litigation throughout the world. And I cover offshore drilling, launched coverage last year as part of my energy services coverage. And we carry much of the Westwood rig logics data on the Bloomberg terminal. And that data and analytics informs a lot of my work. And so I consider them an invaluable partner and appreciate very much the opportunity to speak with you guys today. So I'm going to focus more on the investment perspective regarding offshore drilling. And by that, what I mean is talk a little bit about stock performance, talk a little bit about market sentiment toward the group, talk a little bit about thoughts on consolidation, growth strategies, particularly for some of the larger companies, which are the ones that I cover that are publicly traded. And I'm going to kick things off with a focus on stock performance. And for those who can't see, energy is the large tower on the right there. And for those of you who've been under a rock, you know that may not know, 22 is really the year that energy investors have been waiting for. Not even just from a absolute performance perspective, nearly 60% appreciation in the energy stocks. Every other major sector in the S&P 500 was down for the year. So you couldn't ask for a better crystallization of the energy market's importance to the overall economy. The S&P 500 was down nearly 20%, and the NASDAQ was down nearly 33%. And really a few drivers of that, I think, firstly, commodity prices, which are obviously always essential and critical. But not just that, you had the Russian invasion of Ukraine at the start of the year really kind of, drive the point home regarding some of the unrealistic expectations that were out there in terms of the energy transition, which really dominated market talk and headlines in the 2021 timeframe being put to rest. And so that continues to today, just a little bit of perspective. Within energy, oil field services, including offshore drilling and exploration and production, reached up well over 60%, and we're the leaders within energy. The integrated oil companies, Exxon, Chevron, Shell, and the like, up more like 30 to 40%, and midstream up more like 10 to 20. So, you could almost throw a dart and made money in the energy stocks last year if you were long. But the offshore drillers participated nicely. But this chart here really illustrates how much the group is making up for lost time. We really have seen underperformance for several years, including underperformance of the price of oil. I think at a very high level, folks expect all oil stocks to correlate closely with oil prices. I think those arguments are overdone, but generally within the middle narrow band, say, before you get into extreme highs or lows, that does tend to be true. But really, the market had lost confidence in energy. Some of the energy transition talks part of that, but also concerns about the sector's obsession, quote unquote, with growth at all costs. And so we've heard a lot of the large publicly traded energy companies really articulate and demonstrate disciplined growth plans. And I think that's going to continue. The market's been very receptive to that. And I think that's important if we're looking for a cycle that has legs, and frankly, duration is more important than magnitude in terms of the cycle. We've been looking at 10 years, looking back, pretty rough times for the sector, and a very volatile macro environment still. So I think most of the leading executives running all the large companies that we look at are well versed in that philosophy, and that's true both for contract service providers and customers and producers. So the market is still way out in front of energy, and there's a long way to go to catch that up. Looking at the 5-year look back. This here illustrates the performance of various subsectors within oil field services. And what you can see here, other than the fact that all subsectors participated nicely in 22, which is shown in the blue lines, the leaders were generally more shale focused, the pressure pumpers and the land drillers. And there, I think what the reflection is you saw a much more severe decline in shale production in the immediate aftermath of COVID-19. And upstream spending in North America generally was up about 50% last year. We saw a much more severe pullback in land rigs in the 70 to 80% range following COVID-19. And from mid-2020 onward, we saw pressure pumpers lead the recovery with customers attacking record level inventories of drilled but uncompleted wells, and land drillers, following suit close behind. We've seen land rig day rates move from the low 20s on a leading edge basis at the bottom of the cycle to the low 40s. International, had been a prior area of stronger growth and held in much better during the downturn. The diversified oilfield service companies like SLB and Halliburton, Baker Hughes, as well as the offshore drillers, are obviously much more international in terms of their focus, and so you didn't see as much of a response to the resurgence of shale out of those two subsectors. What I think is most encouraging here, looking at the gold bars, is that offshore drillers are leading the way so far this year, in which has been a much rockier environment for energy stocks. The OSX is down 2-3% year to date, and the market S&P 500 up 70%. But the market does seem to have conviction that the offshore drillers will follow through, whereas you probably see the biggest incremental pressure on the shale-focused service providers. As you can see, they're down 20 to 25% in pressure pumping and land drilling. So what I think that does reflect is confidence, particularly in the deep water and shallow water jacket environments that the Westwood analysts referred to, and that folks are looking through some of the weakness that we see in Northern Europe on the semi side, and I think conviction that we're looking at a cycle with duration, and that despite what has been a pretty rocky macro environment, as many of you all know, with oil prices pulling back into the mid-60s following the financial turmoil of SVB, Credit Suisse, and others. Some confidence. Stability has been restored since the OPEC production cuts, surprise cuts, were announced a couple of weeks ago. So we'll see if we see follow through here, but it looks good so far. Let's talk a little bit about the competitive landscape. This chart shows the market share based on the total number of rigs owned by the 5 large publicly traded offshore drillers that I look at, and they own about 30% of the market. I think that you can see a much higher percentage, obviously, if we're looking at some of the more expensive areas like ultra deep water drill ships and harsh environment semis. But what this does suggest is that you could, and we'll see some consolidation continue. We'll offer up some thoughts on that going forward, particularly for the large publicly traded. But this compares with about 50% share of the market for the 3 largest land drillers, and over 60% for the pressure pumpers, which is the area of probably the most consolidation over the last 3 to 5 years, but one there where there was the most fragmentation in the market ahead of the COVID-19 triggered downturn. And so I think we will see some consolidation. We already have seen some since 2020. I think it's probably more likely to be on the jackup side of the market. And we've already seen some of that with some players in the Middle East and some activity there, divestitures, including some mandated following the Noble Maersk Drilling merger. But there's also opportunities to grow. A lot of the large players still have some stacked rigs that can support growth, including on the deep water side, and that might make for a more favorable risk-reward prospect in terms of driving growth going forward and engaging in large-scale deal-making. Turning a little bit to the three largest companies, which are the ones I cover for Bloomberg Intelligence. Firstly, Transocean, and these are all based on publicly stated commentary from the management teams. But basically, as many of you all know, they were the one of the few to kind of navigate the downturn without major restructuring. And so there was a lot of market concern. I'm sure that their investor relations department heard that regarding whether this is a double-edged sword for them in terms of not restructuring the balance sheet. Were they in a position for the recovery, particularly them building two large-scale 8th generation drill ships, which they received delivery of last year, which were a differentiator for them in terms of pursuing ultra deep water, high pressure drilling contracts. And we're working on two, or pursuing two in the Gulf of Mexico with the Atlas and Titan. But given the fact that, firstly, I would say the chart on the left there, they're in white, if you can read that, in terms of the backlog, suggests they haven't had any issues maintaining or gaining market share since the recovery has taken flight. We've seen a large increase in their backlog is as large as the three largest competitors combined. So they seem to be doing quite well. The chart on the right there is the debt to capitalization. Rate is Transocean. You can see the leverage is high, and that's a function of the fact that they made it through that restructuring. So as a result, we think their focus will likely be more on deleveraging their balance sheet than anything else, and establishing a capital structure that will support their intermediate-term growth prospects with them navigating the downturn and completing those two cost-saving goals. Turning to Valaris, Valaris is the largest in terms of the size of the rig fleet, as you can see on the left there, on the lower left chart, and much more of a tilt towards jackup, including benign jackup drilling. And so the key differentiator that they've really been emphasizing in the market is their ownership stake in ARO Drilling, which is a holdover from Rowan. And that is not consolidated within their financials, as many of you know, and so it's not as obvious to the market as they would like to folks to realize and recognize. And so that joint venture focused on shallow water drilling, that is with Saudi Aramco, and they have a contract long term, in addition to the 18 or so rigs that ARO Drilling operates. A handful of which are Valaris rigs, that they're going to build 2 new rigs per year for the next 10 years, and they're supported by multi-year contracts with Saudi Aramco. So good long-term visibility on a recovery in the Middle East and benign drilling in shallow water. For capital deployment focus, it seems to be more of an, although they have a balance sheet now to support deal making, the focus is more on reactivating stacked rigs. They completed 4 such projects last year. And they were talking about $50 million per at the time, 6 to 12 months. Now they're committed to 2 at least for this year, at least based on what they've already said. Those are now running more like $75 million per in a 12-month horizon. So they still have a couple of additional stacked drill ships that can pursue work and options on 2 other stranded new builds at or below market rates. So I think their focus will be more so on utilizing those and winning work that can justify a reactivation rather than pursuing acquisitions in the marketplace as best we can tell. Lastly, Noble. So Noble really is emerged as a consolidator. as many you well know, since 2020, with Pacific Drilling in 21, and Maersk Drilling last October. Those deals doubled their size. You can see that huge spike in their revenue quarterly in the lower left there, and the key differentiator for them, we have listed the CJ70 ultra harsh jackups. It may take a little bit more time for them to realize the full benefits of that, given what we've seen in Northern Europe. Heard from Teresa earlier, but that should come ultimately for us 2024. And they're busy integrating that. Maersk deal is double their size, obviously, and they're expecting the integration maybe, I don't know if it's fully complete by the end of the year, but it should take most of this year, and that should keep them busy. So while they also have the balance sheet to do deals, and their rig fleet is more highly utilized than either Transocean or Valaris, and they have less capacity on the sidelines, I think that they're going to be busy with integration. So long-winded way of saying, I think other folks are probably going to be more involved in the large-scale deal-making than any of these three companies. You may see some selected asset purchases they need to do to support growth, and they don't have the capacity on the sidelines to support that. But there's plenty of folks that don't cover. Seadrill, as many of you well know, completed their acquisition of Aquadrill last week. Former Seadrill partners, and is pivoting more from jackup work. I think they sold their jackup fleet to AES last year. Ahead of this, is pivoting more towards the ultra deep water and harsh environment markets. We also had a Bloomberg news report last week on Vantage Drilling, which said that they might be up for sale. Who knows what that's going to happen with that? But there is plenty of opportunity for deal making. We've also seen with Shelf Drilling buying the jackups that were required to be sold by Noble with the Maersk deal to Shelf. Shelf recently there. So there's a lot of players below the top three here that we covered in terms of size that could be involved in the deal making. So if and when there is consolidation, I think those are likely to be players in Seadrill. Is maybe one of the ones to keep an eye on there. Parting thoughts really quickly. Energy, including offshore drilling is back, and I'll reiterate all the points that we made at the outset. But the second point, again, to emphasize this. The other thing I will mention is the fragility of the market. Look, we're in an environment. The stock market was down nearly 20% last year, and if COVID taught us anything, it's always an exogenous shock, either to the negative or the positive, that upsets the apple cart. And so, hopefully. Oil prices hang where they are, and certainly they have done better than gas fillers in the last 3 to 6 months. You never know where it's going to come from. And we certainly didn't see SUV coming, and we saw a few really shaky news for the market. So hopefully we see duration here. Hopefully we continue to see disciplined growth out of the entire energy complex. That is what the investors want to see for energy to remain in favor and grow as a long-term option for long-onlys. Offshore consolidation wave may not be over. I mentioned that. Capital markets, volatile, open energy. A couple years ago, we were hearing, extreme talk about capital, some banks basically getting out of the energy business. A lot of sell-side shops moved away from coverage of the sector almost altogether, and really embraced energy transition. And a lot of oil field service analysts suddenly became energy transition analysts. That's created an opportunity for me, I think, and an opportunity for RigLogic, using their data to continue to cover the sector. It's been a home run for us, and we really liked the fact that we were able to have a proprietary data source that we could leverage and add value to our coverage. The capital markets, both Noble and Valaris, have done bond deals since they both announced them the Monday after the OPEC announcement that weekend. So capital markets do seem, certainly the rates aren't what they were 2 or 3 years ago, but the sentiment towards the sector is certainly better. Energy transition expectations certainly becoming more realistic, as I mentioned, is a key catalyst for the sector's strong performance last year. But the last point I want to make is that ESG is a trend that's here to stay. And they're not synonymous. There's some overlap there, but We've probably done more hiring in ESG than anywhere else within Bloomberg Intelligence within the last year. We've developed a proprietary rating system. I'm not an ESG analyst, but we have several experts. So if you're looking to talk to somebody there, I encourage you to reach out to us. But we're talking about disclosure requirements, not just for emissions on the E side, but also things that affect the social and governance side of things, like hiring practices, corporate ethics, things of that nature. I've been in the business of research for 20 years, and I've heard ESG was around when I started. I have never heard as much interest and emphasis on it from the companies as well as from the investment community as I have right now. So for those of you folks that are in the business, certainly want to keep that in mind. And I'll leave it there.
Thank you very much, Scott. If I could ask the rest of the speakers just to pop up on stage. We've got 20 minutes-ish. We'll go as short or as long as we need to. If we rush to a break coming in. Scott, for you first, I think. We, in the preamble, we spoke a little bit about it in terms of the economic side of things, but in terms of what are your thoughts on the energy sector leading into a downturn and you speak to listen to potential recession?
Yeah, I mean, I think the thing to keep in mind is every downturn is different, every recession is different. 2008 is a whole other conversation from what we're looking at right now. And energy is broadly speaking, is a cyclical sector. I think conventional mindset might be that you sell energy and you buy waste companies, which I also cover. Because they're defensive. That's a generic mindset. That's an initial response on the part of the market. But the much more important variable here is the macro landscape as it relates to energy. And there'll be some ups and downs based on some exogenous factors. There always are. Those are difficult or impossible to predict. But I really think sentiment toward the sector, coming out of the gate even this year. And sentiment from a market standpoint is probably improved as well. I'd say sentiment towards shale is probably worse than since the beginning of the year. Sentiment towards energy, again, before the stocks performed, suggests that folks are confident in offshore. I know you guys talk about, break-even thresholds in the various basins. So if oil prices go down to $60, I promise you stocks will get killed. All right, and you guys may say, hey, we got under $20 before you really have to worry. That's not the way the market works. As far as we can tell, what we're looking at, I'm not an economist, but I've been through a couple of recessions, and it's a very different scenario from 2008, where it hit 150 and then was down to $35 a barrel, right? So as long as the backdrop supports, I always like to think as long as we're kind of hovering that $70, $80 range on oil, we're fine. Stability is much more important than anything else. But I think market sentiment toward the group will remain favorable, barring what we call a hard landing. And so we don't see any reason to expect that at this point. Our economists don't expect that either. We really haven't seen the economy start to, really worsen from an inflationary standpoint. And if anything, the banking crisis with the regionals has probably created more mindset within the market that we're less likely to see an overly hawkish Fed. And that would be something that would be a risk to the downside in that regard. So I've probably gotten more encouraged from a long-term perspective, so that as long as we're looking at, at worst, a shallow recession or maybe not even, the next couple of years should be good for the group.
Thanks, Scott. Question here in the corner.
Yeah, good morning. I guess it's Teresa or Terry or even Scott, or you can debate if you want. Question around new builds that we pick up, especially floaters and maybe real ships, we see the high utilization. However, I'm going to frame it a little bit. There are still ships that have been abandoned in the shipyards. The shipyards are not really very interested in talking to anyone, I guess, about, that's what I think, about building new ships, because they've been left with, probably a hole in their finances. As you know, the ships are sold for $200 billion, but they were ordered for 600, 700 or more. Drilling contractors don't have the money to do it. Either they got a lot of debt, or they just don't have the cash, probably won't have it in the near term. And then, so the question is, why talk about new builds? What would be the cost for a new build? Who's willing to build one? And ultimately, I guess with what I described, an operator would have to pay for it, and would probably also have to show up with a lot of money up front.
Yeah, I would think that a shipyard, to even consider building one, would say, okay, instead of their payment schemes that they used to take, would probably say, we want half up front, or whatever that might be. And I would assume the cost would be, if we were talking about $700 million for some of those ships before, I gotta believe it's not gonna be any different from that. I don't know why it would be less, given the increases in steel prices and everything else. So you're right. And a drilling contractor, I don't think would build one without a contract in hand, obviously. So then how much the operator would get involved in that would probably come into play as well in terms of the cost. So the drilling contractor may require the operator to come up with some money for it, just like the shipyard, would be to the drilling contractor. But it seems far-fetched that there's going to be any orders. I mean, I think if there is special circumstances, niche building here and there, but I don't see any large-scale building programs at all until, as you say, that excess equipment that's already there disappears some more.
Hopefully those are good.
Yeah, I probably just to kind of reiterate what Terry's saying. I think we'll probably see more emphasis on what's already there, what's built, what's stranded, in terms of the new builds, and probably the reactivation of those assets that are, make sense. But on the flip side, I mean, I think if it was, this time last year, if you even mentioned a new build or a new building, people just laughed. But the last sort of results cycle for the drillers, people are talking about it again. I mean, it might not be we're about to order something, but people are, I think it's in the back of the minds, that the fleets have aged quite a bit since the last new build cycle. Some of the stranded assets are, pretty old now as well. I suppose it does kind of depend on what Scott was kind of talking about. It's how long is the recovery going to go on for? And so I think there's a lot of those questions in there as well. But from what people have been saying is that I think to order a new build, you're not just going to be looking at a 2 or 3 year contract that's going to be needed. It's like a 6 to 10 year contract, and you're going to want backing from operators and probably some kind of special deals and financing that's going to go on behind it. Like you said, I think it's going to be probably still a lot more difficult. Like you said, the shipyards have been not quite as open to building again, I suppose.
Although I will say it's odd to call a rig built 10 years ago a new build that hasn't worked. That's still kind of this weird dichotomy to me. So it's almost as if those are going to be new builds because of all of the upgrading that's going to have to be done to them, I guess, to get them up to today's standards, I guess, so to speak. So it's there's enough money in that to create a lot of spending requirements.
Scott, thanks. One question back here.
Thank you. You talked about day rates on drill ships undershooting your expectations. for the last quarter or two. Why is this happening?
Well, basically because of the supply, there's, drilling contractors in this sort of upcycle it hasn't been like past upcycles where we've seen the market go up and drilling contractors, let's order rigs, and that's how we got into the trouble that we were in before this one, because there were so many rigs ordered and built in that 2011 to 2014 period, and then the market crashed. Well, now they don't have the money to do that, so we haven't, which is good. So we haven't had excess supply come into the market, so it's just a simple thing of that. At the same time, supply has done this, and finally demand in the beginning was also doing that, so you still had excess supply, but now demand is going the other way, and supply has done this, so they're meeting, and you see the shortage of supply. Well, that's a good question. I don't know. It seems like there's been a slowdown in contract awards, and whether that's purposeful or not, I don't know. But at some point, because day rates had started going pretty substantially up pretty quickly, as they tend to do when the market starts improving. So whether operators looked at that and said, let's just slow down a minute, maybe let's just take a look. I don't know, but I think it's because that contract award pace has slowed down, so I don't think we've seen the continued trajectory. Now, should that change and operators start awarding some of these tenders, for some of these tenders that are outstanding, maybe that changes things. That remains to be seen, but what is being bid versus what's being awarded are, of course, two different things. But that will continue. The contractors pushing and the operators pushing back the other way. But I think it's just the slowdown in award activity that's primarily the reason.
Yeah, I think just to add to that.
Yeah, just chase 10 mil.
You're on.
Yeah, I think just to add to that as well, travel project, it's more or less the operators trying to control the market right now. You see the likes of Total Energies coming out, being vocal around delaying projects, learning from the mistakes made in the 2011-2013 cycle when people were sanctioning projects at all costs. So trying to pace themselves better. We saw the same situation with Shell's Gatwick Tomato, which was delayed for about 2 years. Currently anticipate that might be sanctioned in 2024. You can look at a large project like the Westwood project in offshore Norway, which was meant to be last year, now delayed at least until 2026. So overall, operators have actually realized that there is no capacity within the marketplace, even from a trader's perspective or from a shipyard perspective when it comes to building production facilities or the supply of subsea equipment to really meet up with the demand that came with the rush off. I would say an exponential recovery in energy demand post-COVID. I think no one was really forecasting that the market was going to recover that quickly, especially energy demand. And operators reacted more or less knee-jerk reaction like we always do within the energy industry. Once there's a downturn, everyone shuts the door. Once there's a recovery, everyone tries to open the door at the same time. And that's more or less created a perfect storm. So you're seeing a lot of big operators that are operating in very marginal kind of break-even areas, trying to pace themselves now. You can continue to roll out different projects. Offshore Australia, you can talk about the Trinidad field that was also built last year. It's all around operators trying to get the best price possible. They've actually seen how much or how low the supply chain can be over the last few years, stemming from the 2014, 2016 downturn. And I think that's what they're trying to do now. We've kind of got into a threshold that is becoming ridiculous, some of the pricing that you're seeing out there. But I think everyone is trying to dial on that.
Yeah, I would add that, as I sort of alluded to, some of these tenders, you see these particularly I've seen it in Brazil in recent years where the spread in what's bid is so wide. I mentioned in the jackup, it's 99,000 to 205,000. I mean, that's a huge, and we've seen it in some of the floater bids as well in recent times where you see 190,000 and 380, or whatever the numbers were. So that also tempers the high end of rates as well, because when companies are bidding at those kind of numbers, you can't drive rates up. So that certainly has some impact on it. Now, I would say for tenders outstanding right now, most of that work is not until 2024 start. So, and even some later than that, you see Treon and some of those projects that there's tenders out for, but it doesn't start, drilling doesn't start till 2026. So drilling contractors are going, you want me to bid for a rig in 2026? Okay, 600,000, you don't really know what that number is. So it's going to be interesting to see how that progresses in the coming months with some of these awards.
Thanks, Terry. I'm keen to get around the room, so there's a few questions coming.
Good morning, I'm Sean Toraldi. I take care of the geothermal segment for Weatherford. My question is that are you tracking investments in energy transition or new energy for offshore rigs or contractors, given that their carbon footprint is way larger compared to land drilling? And are you starting to see that being a consideration in rigs or as a requirement as to what is the typical carbon footprint of a rig, and how does it compare with the other rigs that are being bid?
It's probably on for 3 reasons, so I'll run back.
Thank you. Yes, we are. We are not forecasting. I know some of our competitors are kind of modelling and forecasting individual rigs and things like that. But what we're doing is just tracking what's reported by the individual drillers. So what their emissions are, what upgrades they're doing to rigs, and to help with their emissions. So it could be the installation of certain systems. We're also tracking where we can get the information about things like carbon capture drilling campaigns, for which there are a couple happening this year. And obviously across different segments of Westwood, we're tracking different parts of sort of CCS chain as well. And we hope that will result in us being able to do some sort of demand modelling and things like that in the future. But because it is quite a new sort of segment, it's quite difficult to do that at the moment. But we're tracking those that are, for instance, if we know our operators coming out for it's coming out for the tender inquiry for a CCS drilling campaign, and then we're tracking that in the system as well. But on the energy transitions side of things, we just currently have a report, and we also track within RigLogix the upgrades to a rig system that have to do with sort of reducing emissions during a drilling campaign. And with the report that's updated twice a year. So it's really, we try to do that after the companies come out with their ESG reports.
Thanks, Tracy. We've got a question over here, one to the left. We do also have a few that were sent in advance that we'll try and get around to.
Hello, Terry, you mentioned the clean rates for rigs. I was curious if those rates that we saw last year, the 400K for floaters and 128K for jackups, any of that include like the mobilization or reactivation, or are those clean?
By and large, those, to the extent that we know, were clean. I know there was one that was 450 that there was some question on, but as our understanding was that was clean and was excluding all, any additional costs. Now, the old saying is our data is as good as what we get. So we can ask the question to a drilling contractor when they maybe have a contract, we can ask the question, well, how much is the mow, or does that include it? You know, sometimes they tell us, sometimes they don't, but generally we can get an idea. But all the rates, as Teresa said, sometimes you just have to report it as it's announced, which may include some extra cost. But I would say, by and large, the large majority of the rates that we publish, that we put at RegLogix, are what we determine to be the clean rate. We only, very few do we try and put in that. And in fact, I think even sometimes we won't even put a rate in, even if we have a contract value, but we know that it includes other things, we'll just leave the rate blank until we have an idea of what all that extra taken out might be. So most of what we're reporting would be clean.
Thanks, Terry. Question over here, just a quick reminder, the feedback forms on your table, if you'd be able to just leave them on the table when they come up.
Good morning, Calvin Holt with DrillDocs. We actually put new technology on drill ships, so my question's around the clean day rate, and kind of to Sean's point. Are you seeing any movement by operators to ask for more services integrated onto drill ships like turnkey that we're seeing on land? And the follow-up is more towards automation and new technology. How are they differentiating themselves in a tight market?
So I think by and large, yes, you're seeing more contract tenders coming out that are requesting integrated services, and some services that typically the operator is responsible for, that they're now wanting rig owners to take. So I think, yes, there has been in that regard. In terms of how they're differentiating themselves, I mean, you know, that's almost a rig-to-rig thing where you can say, well, we've got a 2.5 million pound hook loader, we have MPD, or we've got full MPD, you know, whatever it may be, but a lot of it depends on what the requirement's asking for as well. But, you know, I don't really know what, you know, in terms of how they're differentiating themselves, you probably have to ask them. You know, I'm not sure what each individual is doing. I mean, do you have any comment on that?
Yeah, I probably similar to what Terry's saying. I think it varies from company to company. Most of them are here. They're wanting here today, so you could probably ask them. Yeah, I think like more automation, and I think there's still a lot of emphasis on you know, upgrades to technology that's going to help with efficiencies, so drilling quicker, which can help lower emissions as well as save money and time, and more safety conscious. I think there's still a lot of emphasis on that.
They'll always tell you, well, we finished this program 50 days early, you know, or whatever, and trying to touting their services in those ways. Now, in terms of what she alluded to, the adding of all of the emissions equipment and the classing, you know, getting an ABS classing of what do they call it?
Adaptation,
yeah. Different things like that might be some of the things they're doing.
Yeah, but with those sorts of things, obviously, they're quite expensive, and I don't think there's too many companies that are just going ahead and investing in these things speculatively. So I think a lot of it is client requested, or you know, where the demand is for these sorts of things from the actual operators themselves.
Thanks. I'm just going to consolidate our questions that came in advance. Terry, we discussed this yesterday about NPD, but perhaps you can just speak to this a little bit. The questions were centered around any insight on deep water market expectations on NPD rental versus purchase, trends in the adoption of NPD equipment for deep water drill ships and semis, and similarly, our opinion on potential worldwide floater rigs using MPD? I think you can talk around it a little bit.
Well, as I'm told, and I'm sure there's some people out here that have a lot more knowledge on it than I do, but you know, what a drilling contractor used to charge extra for MPD, say it's $40,000 a day. Well, that number now might be $140,000 a day because the Weatherford, as I understand it, Weatherford doesn't really have anything. You know, if you want to buy an MPD unit, that wait time is quite long now, and the price has gone way up, as have the rental rates. So it just goes the way it should. Where rig rates go up, well, obviously rig supply bids those prices are going to go up as well. So drilling contractors, as we've talked about, don't have the money to go out and buy MPD systems. Some of them may be sort of taking them off one unit and putting them on another, maybe have one spare somewhere around, but by and large, the supply of MPD equipment is pretty low right now, so I don't think that it's not like we're going to see a big expansion of MPD equipped rigs, that population exploding anytime soon. However, it seems like more and more operator requirements are calling for MPD systems, so you would think that a drilling contractor that's certainly something they want to get on their rigs. Now, a lot of that expansion may come as part of a rig reactivation program, where that's part of what happens in the reactivation as MPD gets added. But in terms of just going out and being able to put it on, I don't see that being a big part of it, but you would still think going forward that the fleet size would have to be increasing.
Excellent presentation, so thank you very much for having us today. It's a question for Bloomberg. So you mentioned that ESG is here to stay, but at the same time you mentioned that investing in communities more open to energy. So for the particular subsector of the hydrocarbons of the energy industry, this open-ended question, any commentary about market sentiment, about how this more balanced approach to the energy transition is being done in the investment community?
Yeah, I think, can you hear me now? Okay. You know, I think of it as different things. You know, we had heard 1 to 2 years ago regarding this big push for ESG. We heard about it internally. And it's almost as though this increased interest and commentary from the you were hearing this increased focus from the investment community on the topic of ESG. And so when we're building, you know, we started hiring maybe 1 to 2 years ago, ESG specialists from SCI and Sustainability, I think it is, almost in anticipation that this was going to be a sustainable trend. They wouldn't want to make those types of investments and spend a year developing a proprietary system, which is about as long as it took for us to do it. And so that was what suggested to me that was a sustainable trend. The other thing that validates that, obviously, is the amount of time that we hear CEOs, pretty much say it's almost a standard rate on earnings calls in the prepared comments, talk about, the progress they're making or the highlighted areas that they're strong or areas where they're making progress. And so that is what suggests to me that is a trend that's here to stay. Historically, the emphasis has been much greater in Europe than here, and that still seems to be the case, and Europe's interest and focus on it seems to be progressing at a faster rate incrementally than is the case in the US. Separately, and tell me if this doesn't answer your question, regarding the energy transition, I think certain barometers, including some of the more speculative stocks that are energy transition stocks, to kind of gauge market sentiment towards the energy transition. And so that really was a lot of those more speculative, almost like tech stocks, whether they're hydrogen stocks or other areas, niches within the marketplace that really are indicators of that sentiment really increasing. Also, the media, the news flow you see within an organization like ours, which is pretty progressive, really kind of suggesting that. And so there, I think the market stock performance suggests that has continued to be diminishing. The unrealistic expectations there have been diminishing and remain more realistic. And a lot more focus now is really on the Inflation Reduction Act and some of the public policy measures that support included in the IRA. There are new production tax credits, investment tax credits for hydrogen for the first time. You have tax credit that cover the waste sector, and they're all investing in renewable natural gas and renewable electricity projects from biogas produced from landfills. And a lot of this regulation is still being sorted out and finalized this year, but the first indications of that were when that legislation was passed last year. And so that suggests to me this energy transition is certainly happening, and a lot more of the focus now from the investment community is really on assessing, firstly acknowledging that energy is a growth sector for the foreseeable future. There's some focus on where we get peak oil, but also from an energy transition sector, some of these more speculative stocks are getting close to the point where we're starting, there have tangible economic milestones that investors can realistically gauge rather than just, announcements and things of that nature. So I think that will allow us to evaluate that progress more realistically and for the market to do so.
Thanks very much. We are going to wrap it up there. We've got about 20 minutes left in the room, so if you do want to sit, finish your coffee, have a chat, tap the speakers up, please go ahead. That's it from us. We'll be in touch in a week's time with the recording, hopefully if I remember to hit record. But for now, thanks everybody. Feedback forms on the table, you can just read them and pick them up. But many thanks to our panel, thank you to Scott for joining us as well. Thank you.